Alright guys, welcome back to the channel. So this video is going to be about liquidity grabs and institutional candles. So I'm also going to touch on, the fractal nature of the market. So I'll go into a bit more depth on that topic in this video. So if you haven't checked that one out, go and check that out. That may help you as well. So this video is in response to a question I got from a trader asking, so a liquidity grab is always followed by an impulse move in the other direction, which in turn creates an order block. Please can you clear the doubt? Okay, so a liquidity grab is always followed by an impulse move in the other direction, which in turn creates an order block, right? So basically what he's saying, or what he's asking, is a liquidity grab, right, is always followed by an impulsive move. Okay, so the liquidity grab is always followed by an impulsive move in the other direction. Okay, and that creates the order block. And just in case any of you aren't sure, what he means by a liquidity grab is above this structure, so like or any sort of swing point, right? So above here we're going to have liquidity, right? Above here we're going to have liquidity. Below here, basically all liquidity is resting orders in the market, right? So where are orders lying? Okay, so after we got short here, there's most likely orders that are lying above this level, okay, from people's stop losses. There's people that are most likely waiting for this to go short and have still got their buy stops over there. Maybe not so much now that we've dropped off. There may be less liquidity above there now. Okay, people that are short have probably taken some targets, so this may have a little bit less liquidity. And obviously above this sort of area, we're going to have liquidity in the form of orders, okay, above this structure that gets brought into, right, and then sold off. Okay, so that is the liquidity grab. This buy to sell model, right? So basically institutions and banks, if they want to buy, if they want to sell, okay, they're going to need people on the opposite side of their orders that are willing to buy, right? So we know there's going to be a lot of orders above this level. Okay, so what we often see happen is we see a buy into the liquidity and then a sell-off, right, once we've filled the orders in this area. All right, so to answer your question about the order block, the way that I define an order block is this buy-in pressure here. So from this sort of area to here, right, that is the order block. Okay, so where the buy-in started to run the liquidity and then we see the sell-off. Okay, so the sell-off isn't the order block, right? That is just the move. Okay, so that's the directional push that comes from the switch from supply to demand. So basically, right, inside this box, this little box here, not the order block, right, inside of this little box, that is we've got to move that like this, right? Okay, so in this area here, right, which is just a blown up version of this is just a transition from supply into demand. So basically what happens in this area is institutions and banks will basically be loading up on sell positions whilst people are loading up on buy positions, right? So people are buying, whether it's through orders or they see a break of this structure and they think the market's going to go long, right? So they'll be buying. There'll be stop losses being triggered, okay? Institutions will be selling, loading up on their orders, right? And when the transition swaps or the supply and demand in the market swaps, as in there is now more demand than supply in the market will drop off. Now sometimes we see this if you was to drop down on a lower time frame, right? So if we just move over again, okay, you can see that this move here, right, looks like just an up. So if we draw it in candles, right, we see an up candle, we may see a bit of a pause, and then we see a down candle, right? And we see down candles, down candles, down candles. Let's say this is the hourly time frame, okay? So let's just see if we can find an example. Right, if we just take a look at this area here, okay, on a lower time frame, it looks like one candle down, one candle up, right? But if we was to actually drop down, what we'd actually see is most likely something like this, right? Where we're actually seeing the transition between the buys and the sells, or all the institutions basically manipulating the market, right? So it's not necessarily goes down, bang, fires straight back up in one big impulsive move. Sometimes that does happen, right? Especially if you drop down to the lower time frames. Again, this is going to be time frame specific. That may happen, but sometimes it may be quite prolonged, right? So they're just they're accumulating or distributing into positions, right? And again, like sometimes it may be quick, sometimes it may be prolonged. There's no sort of like set rule, if you like. Okay, so look, let's drop down to, let's just put this here just so we can find it easily, right? Get rid of some of this stuff. I hope this makes sense. I'll go over it again just to clarify in a minute, right? So let's just clear that lot, right? And we are looking, just so we don't get lost, we're looking here, okay? So if we now drop down, let's say we drop down to like a 5 minute, maybe a little bit lower, drop down to a 1 minute time frame, right? You can see that this move that was actually just one candle down and one candle up on a higher time frame. So the, you know, this, right, so look, we got, that is 2 o'clock, right? That is 1 o'clock. Okay, and this is 3 o'clock there. So these are the hours, okay? So that's 1 hour, that's 2 hours. You can see that what was one down candle and then an up candle is actually a lot of buying and selling, buying and selling, buying and selling, and then we start to push off. It's basically, to answer your question, right, so you said it's always followed by an impulsive move to the opposite direction. Generally, the move that pushes off, like here, okay, normally the move that pushes off, you will see stronger candles, okay, because of the supply and demand situation in the market, right? So obviously you can see there's obviously liquidity above this high, okay, people shorting, bang, it gets ran, right? And then we start to see, as the supply and demand changes, again, if we was to drop down on a lower time frame to here, we'd see the change between smart money, you know, like the accumulation of smart money, right, into their short positions, and then generally this sell-off is sharper than the accumulation. Okay, so so it is more of an impulsive move generally, right? Same here, right? We see a push down. Okay, obviously we got liquidity being generated through here. Again, if we was to, I mean, this is pretty, you know, moved out anyway. So we see the accumulation here. A push down, right? So the sell down into the liquidity, and then bang, a sharper push up, a little bit more, you know, manipulation of orders, and then bang, sharp push up, come back down to test the or our last point of support in the schematic. If you're familiar with Wyckoff, we get a break above the structure, a push down into our last point of support, and then bang, an impulsive move. Okay, so not necessarily a really big impulsive move, but in comparison, right, compared to like the previous price action. Okay, so that's what you sort of got to sort of like line it up with. In comparison to previous price action, generally you'll get quite an impulsive move, right? Okay, so the impulse move in the opposite direction doesn't create the order block, right? What creates the order block is the, at least in my definition, I know there's people that say that it's like the last down candle before an up move, right? But I don't like saying that, because like the markets are, they're fractal, okay? So basically what is a last down candle before the up move on an hourly can be a lot of manipulation on a 1 minute time frame, as we've just seen, right? So look, if we move out to the hourly time frame, okay, this whole move here is the last down candle before an up move, okay? So this is how a lot of people say an order block, the last down candle before an up move, right? But then if I move to a 15 minute, then now that is the last down candle before the up move, okay? So if I drop down to now 5 minute, okay, now this is the last down candle before the up move. You see like how there's a lot of confusion there, whereas I like to look at where the sell started to happen. So what you can do, you can bring on the volume, right? You can either bring on a volume profile, or you can just bring on the volume which comes up down the bottom. And generally when you see liquidity being generated, right, and the sell down through that liquidity, you often see a spike in liquidity, right? We see a little bit of a spike here, okay, and then as we get the shift in orders, bang, there's a big shift in volume, right? And then we start to see the big impulsive moves, like how you put it, right? So it's not necessarily as soon as we see the push down, then we'll see an impulsive move. We see the push down, manipulate the orders, right? Start getting into our buy positions, okay? So sell down into the liquidity. Start generating them orders, right? Start, buying, selling, or buying, if whatever side of the market we're on. In this case, we'll be buying, right? People will be selling, institutions are buying. People are selling, institutions are buying. Especially if you look at this previous price action, right? We're in a downtrend. We've just broken lows. People are selling. Institutions are buying. The supply and demand swaps, and then bang, we see an impulsive move, right? We see a push up, a push back down into that area, right? And then bang, start to see a push off, okay? But when you say impulsive, it's sort of like it's all relevant, okay? So this is an impulsive move relative. Let's just delete some of this other stuff, right? So this is an impulsive move relative to the previous price action. But if you was to compare it to this candle, it's not, it's not, right? It's all compared to previous price action. Exactly the same here, right? So look, we got liquidity being generated through there. Okay, we get a push up, some manipulation through here, okay? And then bang, that's a pretty impulsive move there, right? Compared to the previous price action, okay? Get a bit of playing around, right? Maybe some more manipulation, okay? Just at this structure zone, getting people to buy in off of that structure zone, thinking the market's going to continue higher as we're stalling, and then bang, right? Again, another impulsive move relative to the previous price action, okay? Similar sort of thing here, right? So we get liquidity being generated, sell down into that liquidity, right? Put a push up, okay, get some manipulation of that level, push down, not massive impulsive moves, but they're not always going to be, and that you could argue, or this candle here you could argue is relatively impulsive compared to the previous price action, right? Obviously, it's nothing drastic. You're not always going to get massive drastic moves like this. But yeah, I hope that answers your question. Again, similar sort of thing here, right? We see a liquidity sweep. These candles are relatively impulsive compared to the previous price action in here, which was most likely just picking up orders ready to take the market lower, right? This is the last up candle, okay, before a down move. So technically, this is the order block, right? Or people will be looking at this as the order block. If we was to go to a 1 minute, right? The order block is actually, compared to, with that definition, the order block's there, right? The order block's there by that definition. If we was to go to let's say a 15 minute, right? Now, this is the last up candle before the down move, okay? So that is the last up candle before this down move. You've got to really read price action a lot more and understand that the market is fractal, okay? So, just understanding where the liquidity was lying, where it got, where the institutions most likely started buying in to then sell, and where they're most likely going to want to mitigate from. I hope that makes sense. Now, obviously, this isn't set in stone. We don't always know, right, that is an order block, right? Let's say that we was looking at this move here, okay? We could assume that this is an order block, and obviously it didn't hold, right? And then in hindsight, we know that, oh, actually, this was the order block, right? Because we had the sell down, push up, and then we get some mitigation on that level, right? Now, there is ways of better understanding and better being able to identify what levels are going to hold, because if you start looking for every time you think there's a liquidity grab or an institutional candle, you'll probably get a little bit frustrated. I'm not going to say it's not going to work, right? People say, oh, this doesn't work and that doesn't work in trade, and I don't necessarily believe that. I just feel like they haven't got it to work, right? I honestly believe you can get anything something to work if you put the time into it, and you know, it's like you back test it and you find out, oh, actually it didn't work, but then you sort of tweak it, right? You make notes on it, you know, and you're persistent with it, you will get it to work, right? If you are a good trader, if you understand how the market moves, you're patient, you know, you sort of work with your system, you develop it, right? All people mean when they say it doesn't work is they can't get it to work, right? You could literally flip a coin in this market, and with the correct risk management, money management, a solid trading plan, you know, a way of getting in and out of the market, like I say, correct strict money management, risk management, correct psychology as well, and you know, right testing, you most likely make money, right? So to say something doesn't work in trading is just, it's crap, right? Don't listen to that. So, all right, so just whilst we're on this subject, because this is quite relevant to another question I got from a trader, okay, and he asked, how do I eliminate all the subjectivity in my impulse moves, right? So basically he wants to look for an impulse move up to a level of structure, so an impulse move up to a level of structure or breaking structure, but he wants rules on what classifies as an impulse leg and what doesn't, right? What is an impulsive move and what doesn't. Now this is a bit of, I've got to be honest, this is quite a hard one to tackle, right? Now I know that I always say you should be as rules based, you should eliminate all the subjectivity, but there is very, very odd occasions, and I feel like this is one of them, where specific rules, as in like specific like numeric rules, may put too many handcuffs on you as a trader. Now again, this may handcuffs and a bit of restraint may be good if you're at the beginning stages of your journey, just to help with discipline, and just until you know your eyes adapt and you get really used to the setups and you sort of know what you're looking for. But the thing is with impulsive moves is it's always relevant, right? So I wouldn't want to ever measure a move and say, right, I need a candle that moves up 30 or like 20 pips to be classed as an impulsive move, right? Because look, let's say this price action here, okay, compared to this price action, this green candle is an impulsive move, right? This green candle is an impulsive move. It moves 16 pips, okay? So let's say that we need we need a candle to move 16 pips to be classed as an impulse leg. But if you look here, right, and we zoom in, okay, these grey candles, right, are impulsive moves compared to the previous price action, right? So compared to, you know, these candles, right? These grey candles are impulsive moves. I don't know what is going on with my mouse, but it's messing about. So, and obviously these only move, you know, 8 pips, 9 pips, right? So it's a little bit hard to sort of put a rule on that. I'd just look at it compared to the previous price action. Right, and again, let's have a look, like here, right? Like this, again, this is quite an impulsive move. That's 16 pips as well, right? But it's quite an impulsive move compared to the other price action. Now, if that other grey candle was here, right, and it was like an 8 pip candle, let's say we had another candle that goes sort of there, like that, you know, 6, 7, 8 pips, it isn't very impulsive compared to the previous price action, right? But if it was here, okay, let's say that we are now looking at this price action, right? If we then get an 8 pip candle like we do here, right, not even that, that's like a 3 pip candle, 3 or 4 pip candle, right? But compared to the previous price action, it's quite an impulsive move. Okay, so look, that's a better example. That's probably more like a 6 pip candle. 5, or this grey one here, look, that's 6 pips, right? Compared to this price action, that 6 pip move looks quite big. But then when we go over here, right, this 6 pip candle compared to this price action isn't that big, or isn't that impulsive, you know? So that is definitely quite a tricky one to put a to put a rule on. Now, I just want to take it back a minute and just sort of clarify why we need rules, okay, and why we want to be non-subjective. So the first reason is to stay consistent, right? Obviously, if we've got specific rules for things, we are going to be consistent, right? If they're consistent rules, right? If you have consistent analysis, consistent execution in what you're doing, you'll have consistent results, right? You'll be consistently profitable. Okay, the first word in consistently profitable is consistent, right? You can't extract consistent profits out of this market if you're not consistent, right? So that's why the first reason why we have non-subjective rules, right? The second reason is for when you're in a situation, right, like this, and there's no money on the line, and you're just back testing and you're just looking, there's no emotion here, right? The second that I see this price action, I place a trade, and now I've got money on the line, right? My decision making changes. Okay, your decision making changes. Whether you choose to believe it or not, right? Your decision making will change once you have live money on the table. So the fact is, what you may previously have seen in your back testing as an impulsive move, as soon as you've got money on the line, you'll probably be like, well, oh, no, that's not impulsive enough. I need to wait. And you may be, you may be a little bit hesitant from taking trades because you haven't got specific rules to tell you exactly when to get in and when to get out. Now, this over time, as you sort of progress and you develop as a trader, and you've seen your setup over and over and over and over again, right? That you'll sort of potentially slip out of that. And look, so basically what I'm trying to say is that we have rules to sort of help us with the emotion in trading. If you go through your testing, you decide that you can be consistent in what you're identifying without a very specific rule, so something that just tells you to look at previous price action, and if it's if the candle is bigger than the previous price action, then it's an impulsive move, right? Maybe not specific numbers, just if the candle is bigger or the selection of candles is, so like this, look. So like this selection of candles is bigger than the previous price action. Okay, so obviously we got the price action and then we got a few candles. If the price action that I'm looking at is bigger than the previous candles range, then that's an impulsive move, right? But putting actual numbers on it, I feel like maybe a bit of a hindrance because again, it's all relevant. So yeah. I know that I sort of butchered that explanation. I hope it helps. It is a very tough one, to be fair. That is quite a hard question. It caught me off guard a little bit, but like I said, I hope it helps. If it doesn't, just come back to me, like with something else, and wherever, sit down and wherever I'll have a bit more of a think about it and see if I can help you out. Maybe you have to send me a trade plan or something like that, and we'll have a look. But anyway, I hope you got value from the video. If you did, be sure to hit the like button, subscribe to the channel, and wherever you are on your trading journey, I hope you have a good week, and I'll see you on the next one.